Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Seth Wunder, Chief Investment Officer of Acorns. We're going to discuss why investors should find comfort in the Fed's hawkish approach. Seth, it's great to have you with us. Welcome to Trade Talks.
Yeah, thanks for having me.
You got it. And Seth, it's a very interesting approach to take because we saw the market's reaction to more potential hawkish policy within the Fed. But let's start with really where the big concern is with inflation. We saw the numbers come in for January at 7.5%, and we're certainly feeling it at the pump and when we go grocery shopping and so forth. So what are your thoughts around inflation and really where are the causes of it?
Yeah, I mean, there's no doubt the inflation data is accelerated quite significantly. We could all look back to the early 80s as the last reference point of anything that looks similar to this. You've got several factors that are contributing to it, and certainly energy costs, as you mentioned. There are supply constraints as well, both in terms of supply chain production capabilities, as well as us human labor, and people being able to find that the workers that they need to keep their businesses up and running. So it will take time for some of those things to normalize. A bit of it is pandemic related. Some of it is going to be a bit more structural, and to the degree that wage inflation gets anchored, that would be a sustained problem for the Fed. And we haven't seen inflation in quite some time, so we'll have to normalize to this backdrop.
Right, and I think it's a good point that you bring up, Seth, because we have this thing in our head that, okay, once the Fed starts to raise rates, there's a magic button and things will go back to normal. But it seems as if this is going to be our new normal for some time at least. So why do you think a more hawkish position should provide some comfort to investors?
Yeah, so there's a few things in that, right? First of all, we haven't had an inflation cycle in a while, whereas we have had interest rate cycles. So the idea of inflation is uncomfortable for market participants more broadly. But when you think about the issues at hand that usually disrupt market trends, it's usually the unknown risks that end up being a little bit scarier than the known risks. And it's nice in this situation that you have a Fed that is laser focused on the idea that inflation is running very hot and that raising rates is their attempt at constraining that. And so the idea that the regulator, if you will, or the arbiter of where rates are, understands that the main issue at hand is inflation, I think should give some comfort that we're not being blindsided by something that's probably going to be persistent for a while. And to your other point, these things don't go away fairly quickly. I mean, we will be talking about inflation and rates as a trade-off, maybe even a soft landing at some point as a narrative over the next coming quarters and maybe even several years. And that will be part of the normal market psychology on a go-forward basis.
Right. And Seth, I think to your point, when we talk about volatility, there's always a negative connotation that's associated with it. We see it in the headlines. We see it in financial media all the time. But volatility can actually act both ways and open up opportunity for a number of different types of investors.
Yeah, I mean, volatility is one of those things when you deal with people's money that psychologically is a little bit difficult at times, but it is where opportunity lies. I mean, if we were shopping in a store and your favorite shirt or shoes were on sale, more often than not, you'd be excited to be able to get that at a discount. When it comes to the stock market and even risk assets in general, it's usually not met with the same level of excitement. But the reality is that's what we're focused on. When you invest for the long term, finding those pockets of opportunities where asset prices are either on sale or volatile gives you that chance to buy something a little bit cheaper than you might like. And I think that logic certainly holds during this period as well.
Yeah, and when you think about it, especially over the past 10 years when we've had a significant influx of new investors to the market, they've really only seen stocks go from the bottom left to the top right of the charts here. And ups and downs in the markets is what creates averages over the long term. And I think psychologically, you need to retrain what newer investors have seen over the past 10 years.
Yeah, the beauty of the financial markets and the distribution of information today allows for anyone to really be a market participant, right? And that's what you want, right? You want individuals as well as institutions to have fair and free access to information to be able to make their investments decisions and so forth. But that does mean that there are new investors in the market who haven't been used to years worth of volatility. I mean, even look at the market since the beginning of the pandemic, it's up 30% off of its pre-pandemic levels and up 80-ish% off its lows in fairly straight lines. So we'll have to normalize to new market environments around volatility. But the important thing is this: volatility usually happens on rate increasing cycles before the Fed starts raising rates. Once we sort of get into that rate rising cycle, the market has historically actually done quite well. And that's because people are uncomfortable going into the process of raising rates. They normalize to that environment. They understand what that means for the economy, for risk assets, for valuations. And then they get back to their investing behavior that's usually funding opportunities over the long term. And so I think we'll start to see volatility hopefully normalize a little bit based off of historical data, and allow people who haven't been comfortable with that volatility in the past find opportunities for investing on a go-forward basis here as we get into the rate hiking cycle.
Right. And then you also have to think about the timing of a market correction. Is this the bottom? Is now the time to go in? But when you think about it from a longer term investor sentiment, really consistency is the key here.
Yeah, there's that old line, like every market downturn is ended with an upturn, right? I mean, that's just the way that the markets go. It is hard for people to psychologically stay consistent, but one of the key attributes of a great investor is somebody who can be unemotional in the face of that volatility. We encourage our customers and so forth to think about the market on a consistent contribution basis, which is known as dollar cost averaging. And I think that if the masses of people continue to hold that, the history of investing says that that's a pretty good strategy.
All right, Seth, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.